The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and thank you for being with me this evening. It's good morning to our friends in Queensland, good afternoon to the rest of Australia, and good afternoon, I think, yes, a good afternoon to our friends across the ditch in the land of the long white cloud. How wonderful to have so many of you with us today. We've got a whole lot of, here we are, Mickey D's with us, first in loud and clear. Thank you, Mick, saved me asking the questions. Mr. Deck's with us, goodness Lord, greetings, John, Merry Christmas to you and your family. Thank you, my friend, and you. You're a voice from the past. We haven't seen you for a while. I hope all is well with you. Okay, so let's move along. We've got people coming in quite late here. Anthony from Sydney, good to have you with us, my friend. Bart, of course. Chase, we haven't seen you for a little while, Chase. Glad to have you back with us. Christopher, glad to have you, my friend. Gig from North Carolina, of course, the world's most dedicated golfer. Good to have you with us, Gig. Jim B from Hull in northern UK. Justin from down the Hunter Valley. Both those guys are tutorial guys, of course. Let's see, here we are. Yep, more of the same. Lots of Davids. Thanks, Dave, you in particular. Good to have you here. Get my icon working here. Grand. Okay. Leo's with us from Canada. He's a tutorial guy. Good to have you with us, my friend. Mark L. Absolutely essential. No party without Mark here. Mickey D, of course. Glad to have you with us, Mick. I'm looking forward to catching up so you can tell me all your news of your great round-the-world excursion. Miles is with us. Haven't seen you for a while, Miles. Good to have you with us. Milton, of course. Nathan, glad to have you here. Partho, he's a tutorial guy. State of my glasses, excuse me. Pietro, good to have you. You're a new guy. Glad to have you. Welcome, Pietro. Ray, of course. Robert, plenty of Roberts. That's Robert. Terry, of course, we're honoured to have Terry here. We don't get him here very often. He's the man. And Wen, also glad to have you, a newcomer. Glad to have you folks. So 2023 is nearly over. I mean, it has been the most sensational trading year of all time. I hope you've shared it with us, and I hope you've enjoyed it as much as I have. It's been quite wonderful. Okay, so let's move along. That, as you know, markets are rational, orderly, and sometimes predictable, and we can look to for that to keep continuing. So this is to be a review of 2023 and a bit of a looking forward to what we can expect next year. And I think it's going to be bonfire night next year. We'll see. But I'm repeating here, praise for the fourth seal, in particular Frank DB, who runs the fourth seal for us, keeps the magic charts, and creates the commentary on crude oil, gold, and the S&P. And this is Frank's story. He came to me as a student, wanted to be a student back in 2011. Said he'd never seen a financial chart, doesn't read financial papers, would like me to teach him anyway. And that happened to be the first time that I taught the fourth seal, and Frank just took to it like a duck to water. Worked it and worked it and worked it for quite a few years. And then one day said, look, I think I could write this commentary for you. That started some years ago, and he's been with us ever since. And he's a man who is dedicated to his craft, and I can't praise him enough. Whatever you have to think about 2023, you have to have on top that Frank was the only analyst who declared that the January 2022 high was not and could not be the final high in US indices, and that a new high was to come. And Frank, congratulations on that. It took real guts to make that statement soon after the previous all-time high, and to stick to your guns right through. Quite wonderful. I'm very, very proud of you. Okay, so let's have a little think about what are the likely time cycles to come in. Well, we know that all the way along, if you've been following how to calculate time, and if you're interested in that, you should go to the articles tab at the Danielcode website and click on the link called The Other Way. It's an analysis of the S&P by time from way back when, a long time, many years, and read through that. It's a big read. It's a pretty dense read, but if you're interested in it, that's the place to go. And what we have seen with these major time cycles in particular are quite extraordinary. And as a result of that, we found that the two swings from October 2018 and March 2020, which was the COVID flash crash, the shortest bull market in history, they become our new bulwarks, and I think time will now run from them. Previously, it was running from the 2007 high and the 2009 crash low, and I think these bulwarks now, which both came in on 59 cycles from the 2007 high and the 2009 low. We're talking about the S&P here, guys. Either the index or the futures, they both work the same. Just have some slightly different nuances. But looking at the dominance of the 59 cycle, have a look what you on this chart here. You can see that the low of this correction from the January 2022 high, that came right at exactly at one of our 29 cycles, well, our only 29 cycle. This is a 24-day chart. I should add every bar on this chart is 24 trading days. And 29 from the COVID flash crash high got landed exactly called the low of this correction. From there, after that, that was first of all the main Danielcode number, or the first Danielcode number. 59.3 is times, a plural. It's two lots of the Danielcode cycle of 29.6. Then we had a run up and a rally from that low into the 37 cycle, which comes from the rule of eights. It's not actually a Danielcode number. It forms part of the Danielcode matrix, but it actually comes from the rule of eights, which is vitally important in all of these markets. So the next significant Danielcode time cycle is going to land on the 4th of March, and that's going to be a 44 cycle from the March 2020 high. 44 is actually the cycle for gold, the time cycle for gold, but it does work and reflect itself in the S&P as well. And on the 4th of April, we're going to have a 44 cycle expiring from one of our dominant swings, and a 59 cycle expiring from the earlier October 2018 swing. So keep that number in mind. The 4th of April next year, as we move through this little discussion, you'll see that that's going to become quite a dominant feature of what's likely to happen next year. This monstrosity is actually the Danielcode chart of US T-bonds, which has been running from October 1998 on. And its feature is that in that whole run-up, you can see some lines across it. They're diagonal lines. They're lines on the angle, part of the fourth seal protocol. And you can see there's a thicker red line in the middle. That's the mean or median. And then the dotted lines are 1, 2, 3, 4, 5 standard deviations from that mean. Those are really, really big numbers, but the high came in almost exactly on one of those cycles at 191.22, correct 22. That little arrow feature is called a correct. And from there, it went down, 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 down. And we charted that We forecast it, we talked about it, and you can see it actually finished up blowing past my worst estimate, which was 114.21, and it looks like it's moved off that last diagonal pattern and found a shorter term pattern, because this hasn't been updated. This bar, the Danielcode standard deviation channels, hasn't been updated since about July, I'm going to say July 2016. Since then, it's been running on its own with the way it was formed, and it's turned out to be, well, prescient is a very modest account of it. It's been absolutely sensational. And if you want a slightly cleaner version of it, there it is. We can see that November 2023 high that skipped off running along the diagonals, it landed right on a fourth seal extension. And the fourth seal is an angle. And in fact, this is a fifth seal version. The fourth seal is an angle that has its own definition. The fifth seal is similar. It starts from a high before the high, which you can see there, and it runs through important swing highs and swing lows, which is exactly what this market did. That caused a little rally up into March 2023, and it went down after that to find its ultimate low so far, and look where that came, exactly on the extension of the fourth seal angle. How did it know that? Markets know all sorts of things, as during the year I'm sure you've seen when we pointed out to you the various marvels of market behavior. That was one of them. So those of you who've been with us a long time will remember that back in the days when I used to write quite a lot for Financial Sense, my underlying message about all of it is that bankers were the villains, and I'm still of that view, and you should be too, because 2023, the dominant events that happened in 2023 were banking problems. And once you understand how they occurred and what steps the powers that be have taken to overcome those difficulties, you will understand why I'm really excited about late March, early April next year. So in March 2023, talk about the Ides of March. Caesar would have been able to tell you to keep a sharp lookout in March. 3 US banks failed. Silvergate Bank, it was a crypto deal. Silicon Valley Bank, SVB, which was the darling of the technico people, crypto people, entrepreneurial startups in particular, and a couple of weeks after that, Signature Bank in New York failed as well. And they all failed for the same reason, that this is from the Reserve Bank of Australia, saying that large valuation losses on securities holdings were the problem. So the non-technical response to all of that, you can read this, it's very straightforward, as that when interest rates vary, so does the capital value of the asset, if it's a bond or a bond type structure. And they work in an inverse relationship. In other words, as interest rates go up, the price of the security goes down, and vice versa. As interest rates go down, the price of the security go up. Now, what happened here is that there were some issues, considerable issues, particularly in the crypto space and associated with those DeFi, they call it, derived finance websites, products, companies, etc. They got a bad shake-up when Sam Bankman-Fried went belly up for billions. and he'd been very much the flag bearer for the crypto darlings, and that gave a whole lot of these associated or even known entities a big shake. And they started withdrawing money from their bank to cover their costs, of course, and their key bank for all of that particular cadre was SVB, Silicon Valley Bank. And eventually it got to the stage that they'd had so much money drawn out that they had to prop up their capital base. And to do that, they took the first step of selling a whole lot of securities. And what their basic model had been was taking deposits and investing them, short-term deposits, and investing them in long-term securities, like treasuries, bonds, etc. So what they found, as you'll see in the next couple of charts, when they went to sell this, and it was about, forgive me for the exact numbers not being on the tip of my tongue, but there was something like a 42 billion asset they sold for about a 40% loss. Was quite massive. And then they tried to do a fixed capital raising, which didn't even bounce. And it was really the problem. How could you have so much of your money in a fixed asset class and not manage it? And it's the most amazing story, which has all been hushed up with lots of legalese and bank jargon. And we'll come to that. But soon after that, of course, a very, very important European bank, Credit Suisse, had its own problems, which were different problems. The bank security portfolio was a much smaller share of total assets, but they've been having some troubles in the years previously. They'd already had liquidity problems, and they'd had some really high-profile incidences, including the big losses in Archegos or Archegos, I don't know how you'd like to pronounce that, which we'll talk about, and Greensill Capital, which was a joke. How all the powers that be, all the way up, and instrumentally the British Prime Minister at the time, David Cameron, could have fallen for that is, it just shows, I guess that's human nature. And it was really something to see, to believe. We've talked about this during the year, as we do our normal webinars every 2 weeks or sometimes more often. I've talked about Archegos, I've talked to you about Greensill Capital at some length, and of course Bankman-Fried, FTX, has had the banner hairlines highlights at that time. So have a look at this. This is the US friendly supervisor, I call him. They're not supposed to be, but they are. And the FDIC is the Federal Deposit Insurance Corporation, which insures bank deposits of up to $250,000 per depositor per bank for each account category. Now we're talking about the USA. In other words, if you had $250,000 in a Silicon Valley bank account, you would get all of your money back because the FDIC literally insures it, and it collects premiums in fees all the time to have the funds to do that. Unfortunately, most of the accounts in Silicon Valley Bank were much more than $250,000, meaning those funds were uninsured. In most cases, this would mean account holders would lose any money above that threshold. But look at this, to help, the Federal Reserve announced on March the 12th it would invoke a systemic risk exception, meaning that all depositors would be made whole, even for those whose funds were uninsured. Well, that's an amazing statement, because what it should really read as is, to help, the Federal Reserve announced on March the 12th that it would not follow the law. It would invent a whole new law for up to itself, and just goes against all of the tenets of prudence and carefulness, commerciality, responsibility, all of those sorts of things out the window. This is a follow-on of Biden's do whatever it takes. And of course, the US government and, in this case, its main financial arm. They just love spending money. Never enough money for them to spend, and they keep up thinking ways to do it. So the real story of what was going on is, in my view, quite hilarious. And Silicon Valley Bank, of course, you'll read in the note somewhere that for much of 2022 they didn't have a risk officer. Well, that's not quite true. They did have a risk officer who was a young lady, and sometime in late 2022, very late 2022, she sold all of her stock in SVB, and she had about $5 million worth of stock, which she'd acquired over the years. I don't know how, either by buying it or by grants or bonus deals, etc. But nonetheless, she had a substantial holding, and she sold it. And this put the powers that be at SVB, this put their nose out of joint. And they said, we don't want you to work here anymore. You've lost your job. And she said, fine. 10 seconds later, they realized that they really needed this young lady to help them find the next risk manager, and they were going to do some interviewing about that. So this lass stayed on in not quite sure what capacity, but she was no longer the risk manager. But she must have been very highly thought of, because she negotiated a $7.5 million payout package, and she was doing goodness knows what. But whatever she was doing or had been doing, she hadn't ever hedged the risk, the insurance risk, the interest risk on the bank's bonds and long-term debt holdings. And that's just pure insanity. That's negligence. I don't see anyone's got sued for negligence so far. And my guess is it gets knocked out in the wash anyway, but quite absurd if you think about it. The Greensill debacle is just as silly. Lex Greensill came from a well-known Bundaberg farming family. Bundaberg's in North Queensland, where I live, and they're huge growers of all sorts of crops, watermelon, spectacular, and lots of others. And what he was doing was factoring. And factoring's been around for hundreds, if not thousands of years. It simply means factoring is a process where you make a sale, you incur a debt, and but you don't get paid until that payment is made. And Lex noticed that his family, as growers of produce, had suffered badly over the years from late payment from their clients. And he very much understood factoring, which was as old as the hills, but he managed to dress it up as something new called debt finance. And somehow or other he got the ear of David Cameron, who was the Prime Minister of Great Britain, of the UK at the time, and he was shown great favour by Cameron. He was given an office in 10 Downing Street, which is the Prime Minister's residence in London, upstairs, and it's the working office of the Prime Minister's department downstairs. He was given an office there. He was given an email address for 10 Downing Street. In other words, he was given a whole lot of credibility and offered lots and lots of government work on this so-called debt refinancing. And what it all swung on was that it was insured by a little-known insurance company in Australia. And eventually it was found out that the manager of that particular little insurer had gone way beyond his allowable limits and what have you. And when that got found out, they wrote everything down and sold off the shell to a Toyota subsidiary, who immediately cancelled all of their insurance with Greensill and his bank, Greensill Bank as it was called, and that just led to the fall down. And of course, one of his biggest bankers had been Credit Suisse, who really took it in the neck again. The other one of interest is Archigo. It was a trading entity. It got hung up on margin calls, trading too big, too extended. Wall Street. This is a guy called Bill Hwang. He lost 20 billion with a B in 2 days. The fate of Archegos has been compared to the meltdown caused by long-term capital management of recent memory. And of course, who got that in the neck on that? His main banker, Credit Suisse. So different reasons, same thing, total negligence and incompetence bringing these people down now. SVB is very, very important because it gave rise how the government eventually solved the problem is requiring FDIC, who itself couldn't fund the deal, to make good all the depositors of SVB. And then they invented what's called a bank term funding program, which is authorized by the Federal Reserve, and it offers loans to banks, credit unions, and other deposit institutions. These loans, which can last up to 1 year, help financial institutions to meet their depositors' needs. In other words, the program also helps to ensure that when banks need cash, they won't be forced to quickly sell high-quality securities to get it. What that really is saying is that the program hands out money to ensure that when banks need cash, they won't be forced to liquidate an asset that's worth at best maybe 20 or 30% of book value, and nobody in that business is marking to market. It's all marked to fantasy, marked to make-believe, exactly what caused the 2007-2009 crash. Here's the sticker. The program went into effect in March of this year and will be in effect until March 2024. So what happens when the money's all gone? Is the government of the time going to be able to face up to extending it? The banks won't be able to repay it. That you can be sure of. So what follows March? April. Things to look at. And the final word, a young lady called Anne Glover, who's an expert on banking, finally got round to stating the blindingly obvious that it was a banking 101 failure, unbelievably irresponsible, frankly, by the senior management of SVB in California. So our little friend Chicky Boo got her $7.5 million severance package. No one knows if the receivers ever clawed it back, but unlikely. But what about the heads of that bank? What about the CEO? 20 million a year plus bonuses. A lot of money for someone who didn't know anything about banking. Okay, so remember creating and trading the Danielcode time signals, which I've been talking to you about all year, is the best trading system I know, and it's only available through a Danielcode tutorial. This is the link to the curriculum, and if you would like to learn how to create and trade time signals, you will need to do a Danielcode tutorial, and I will be delighted to teach you. Do email me, jneedham@thedanielcode.com, if you'd like to register for your tutorial, the source and the pathway to enlightenment. I will be working apart from Christmas Day, so it's a good time while things are a little bit quieter, good time to do your tutorial. Be ready to be a super trader in the new year, and that's all there. So you want to be a trader? Have a look at this video link there. That is of Mark L., who's with us, of course, today, one of our very first super traders, who returned 1,000% on margin in his paper trading of natural gas for calendar 2016. A serious star trader. Okay, we're waiting, and very shortly we'll be going to Greg Paladini. He's going to talk to you all about Danielcode and some trading ideas. So let me just push through the matters I had here of importance. This on the 9th of December with the new 6-day charts, which I've talked to you about previously, that we've started doing again. And they're pretty fortuitous. The last time I talked about it, I showed you how gold, which had that massive spike up and instant reversal went exactly to a Danielcode blue line number that had been on the chart for weeks and weeks. This is the same thing. This is the S&P. If you look at the top of this chart, this was done on the 9th of December. You can see a number up there of 4829.25, which is nowhere in view with the market at the time. Look what happened as soon as that was over the next 2 weeks later. 4830.75 was the current high against 4829.25. That's 5 ticks. Amazing, isn't it? I think it's 5 ticks. I might have done that too quickly. It's very little anyway. It is target recognition, perfect target recognition, and it was on the chart for weeks before it came into play. This is the same thing, another one of our 6-day charts. We're doing them for crude oil, S&P, gold, and UST bonds. There was your key reversal bar looking likely at 67.84, which had missed by about 7 ticks. That's all. Look what's happened straight up. Okay, you should be getting these charts. If you're a serious trader, it gives you an otherwise different view of where the market is, what its likely longer-term targets are. If you'd like to subscribe to these, do send me an email, jneedham@thedanielcode.com, and I will be more than happy to add you to the list of folks who are getting those special charts. So here's our highlight. Our special guest today is Greg Paladini, master trader, wealth manager, Forex, now a future Supremo, was a Forex trader. And Greg started with the Danielcode in 2015. He did his first Danielcode tutorial, I guess it would have been in Los Angeles in 2016. He then came back because in 2016 I wasn't teaching time, I was only teaching price. So he came back in June 2021 and did his second Danielcode tutorial specifically to learn about creating and trading time signals. Now, at that time, Greg was a Forex trader. And during the process of doing his second tutorial, he very, very generously said, look, I'll put all my experiences up in a forum, which all your members can go and read. Good, bad, or otherwise. I said, well, that'd be wonderful, which he did. And it was sensational. And we're so incredibly grateful to Greg for having the confidence, I guess, is the question, to tell us about all of those issues. So he's going to talk to you today about all of those issues. And let me see if I've got a next chart for him. Of the two he asked me to compare. This is one, and let me see where we are over here. Here we are. Greg Paladini is here, and okay, we should be able to hear you. Can you hear me all right there, Greg? Can't help yourself. You are muted. You are self-muted, Greg. You need to unmute yourself. Oh. Okay, that's better. I heard you moan. Can you hear me now?
You got me now, John?
Yes, I've got you. Thank you, my friend. Okay, well, thank you so much. Thank you so much for being with us today, Greg. I know you're very busy. It's very kind of you to give your time to our clients and friends. And I've got the chart up here that you asked me to do. This is the S&P E-mini with the FOMC meetings on it. But I will now just hand this over to you, Greg, and let you tell the folks all your thoughts and the exciting things that you've seen and done. And as I say, I'm most grateful for you being with us. So over to you, ladies and gentlemen. This is Mr. Greg Paladini.
Yeah, John, you bet. Great to be here. Just greetings from Northern California. I'm up in the Sierra foothills of California. And it's actually kind of funny because we talk about the cycles and such, and we're here on the shortest day of the year, shortest daylight period of the year in the Northern Hemisphere. So it's great to be here. Excuse me, I got a little, I'm coughing a bit. No, I'm not smoking Humboldt County cannabis. I've had a respiratory infection. I do wonder though if some of these politicians in Sacramento, what they're smoking, and also these executives at Silicon Valley Bank, what they've been smoking, because this is really a great transition into a point I want to make is it is being able to take control of your financial future is so essential right now. I can't stress that enough because what's ahead after we've had the greatest bull market in history is going to be some fireworks, as John said. I think they're going to start as soon as 2024. So in order to be able to manage your own money and basically be in control of your own finances is going to be huge. Whatever way you can find to do that, you need to pursue it. And I think trading a Danielcode is probably one of the best ways to do that, because there's going to be a lot more manipulation, a lot more stuff going on with the governments of this world and with the markets out there. We all know they're manipulated. That's necessarily a bad thing, but it allows us to basically use the Danielcode to take advantage of that, right? To get that edge. Yeah, Silicon Valley Bank, and yeah, some spot on stuff, John, what you just mentioned, what's going on, not just here, but in Great Britain and in Switzerland. It's deeply concerning. Now it feels good with what's going on in the markets right now because they just made new time highs. Most of the markets did. So kudos to Frank DB because he nailed it. But I think we're coming to a head sometime in 2024 that will result in some pretty severe volatility, and that's our friend. So I just wanted to make that transition into what John was saying is just perfect for what I think we're looking into the future. And I don't think it's going to be a very easy market to manage with your retirement money. It's really about, one thing I want to make a point about from my experiences is that it's not so much about your net worth, it's more about your income. How can you generate income through rough times? Because we've all seen in 2008, the COVID crash, how we've taken significant hits in our net worth. But if you have income, meaning streams of income, and you can trade as what could be one of those, I hope for most of you that's what your goal is, if not already, that you can generate streams of income through your trading to basically manage anything that comes your way. That's because it's going to come your way. You know what's going to hit the fan sooner or later. We've had too much up, and you're going to see some down. But as traders, as John always says, we can make just as much money when the market goes up as it does going down. In fact, you can make more money quicker on down moves, bear markets, crashes. So stay tuned, stay focused on what's about to happen because it's going to get really interesting. So just a quick background. I have to say, listen to what Mark L said. He's spot on. So I don't need to get into too much about my experience because Mark really hit it on the nail on the head. And so just listen to what he has to say. My experience was very similar. John's very good, the best at working with you as a trader, especially a new trader or even experienced trader. Well, I want to say one thing. Being a new trader, you have an edge just being a new trader because you haven't learned bad habits. As experienced, quote unquote, trader, I was coming to Danielcode. I had bad habits. It's a lot harder to break bad habits than develop new habits or new skills. So as a new trader, you can really take advantage of this and learn the right way from the get-go. As my grandfather always used to say, if you're going to do it right the first time. So that's something that really helps you as new traders or less experienced traders. But again, Mark L, I have to just validate everything you said. Just to make a couple additional points, John, I actually started trading futures back in early 2000s. My first trade was unleaded gasoline when they called it unleaded gasoline. Now it's RBOB, reformulated blend stock, oxygenate blending. Just call it unleaded gasoline. Come on. But and whatever, they have to always overcomplicate things, right? So my first trade was a loser, trading way back, following Larry Williams, which John has taken many courses or a couple of courses from him, and also people like Jake Bergstein and following seasonals. All garbage. Sorry, I'll say it. They don't really help you be successful as a trader. Can you have good runs with all these other programs out there, including all these things on YouTube? Yeah, you can have good runs. There's some decent programs, but are they sustainable for the long term? And honestly, I've looked at a lot of things. I've actually looked into bots, algos. Those have so much volatility and are so hard to deal with the drawdown, and you give up control. Again, what I mentioned earlier, having control of your financial future is the key. Making the own. I know it's kind of enticing to follow somebody's trades. Like we'll send your trades to your text, and believe me, don't go there. It doesn't work. It doesn't work. You may have a few winning trades, and it may make money short term, but virtually a lot of traders end up losing all their money back. Their bank is gone, even if they've up hundreds. I've had traders that I know who have made over $100,000 in 6 months and gave it all back because they don't have a set system that really works and endures. It be able to stand the litmus test over time. That's the key. And I know from my experience, going back here to my experience, John, I just looked it up last week. I started with a Danielcode back in 2011 when it was pretty much just the Forex crosshairs.
Yeah.
And yeah. I signed up as a member, and then I think I discontinued being a member, got back on board when I was trading Forex after I was trading futures for a couple of years following Larry Williams and some other individuals. And so I continued and did okay, but it was again sort of that back and forth. So in 2016, I was signed up for your training down in, I think it was Newport Beach or somewhere in Southern California, or we call here in SoCal, down in SoCal, Southern LA. And then I had a basketball related injury, playing pickup basketball. I'm not a professional caliber, believe me, but I was really disappointed. I couldn't make it, and John agreed to do a virtual training with me. I think along with Mark L. I was one of the first individuals in 2016 to do a virtual training, and we did it, and I learned basically price at that time, more about price and the origins of the Danielcode and the math and everything behind it. And I made a mistake. I didn't paper trade long enough, and I didn't say discipline, because remember, I had bad habits. I started trading following other people, and I had a hard time breaking those bad habits. But I knew there was something about the Danielcode, and I couldn't quite put my finger on it, but I knew there was something kind of unique about it, because these numbers that the price action hits just can't be happenstance. There's got to be something to it. So I struggled for a while, and it did okay, but it was again sort of like make some profits, give some back, 2 steps forward, 1 step back, 1 step forward, 3 steps back. It was just back and forth, back and forth. And so it was a rough ride, and it did okay, but I hung in there, and I was about ready to throw in the proverbial trading towel when John started talking about trading time. And that just was fascinating to me. And so I signed up for a second tutorial in summer 2021 to learn about time. And the first session, I learned that, by the way, don't ever say shrimp on the Barbie. It's prawns on the Barbie in Australia. This Outback Steakhouse here in California, or out here in the United States, always say shrimp on the Barbie. And I mentioned that because it was 4th of July, and John came to me and, what are you up for doing 4th of July? We're going to put some shrimp on the Barbie. What do you mean shrimp on the Barbie? Because I was trying to do the, connect with the Australian thing. It's not shrimp, it's prawns. And actually, prawns actually sounds better than shrimp. So I've always said prawns on the Barbie ever since. But so on a serious note, I actually, from the first time John showed me the gold chart, I just like saw on time, trading time. It's like, wow. From the very first session, I said, this makes sense. This can be tradable. This can make profit. So I just latched onto it, and yeah, there was a lot of learning curve, and I did stick to the system, and I did paper trade. Not as long as probably I should have, but I'm kind of the person who likes to just jump in and do it, because there's nothing like trading with real money on the line. So I know trading, don't get me wrong, you need to paper trade. Pull back that instinct to want to put money on the line until you have experience. That's really important. I had some experience, had the bad habits, worked through those, and then started trading time with real money. Maybe a little bit sooner, but it did work out fine. And even looked at other markets like palladium. I did look at the currency markets. I don't have a Forex account, full disclosure. I don't have a Forex account, but I do trade the currency futures now, and it's been very solid performance in trading time. The euro is a good example, or any cross pair. I just got to say, we don't have the chart of it, but if you look at any of the cross pairs, the major cross pairs and the currencies, the Danielcode just nailed the little pullback. And then, of course, ahead of the Fed meeting, which is the point of this slide up here, that you could have got long euro, GBD, Great British Pound, USD, or any of the currencies, Aussie dollar, and gone long before the Fed meeting and done really well through today. So that's one of the points I want to make, is that you can really do well trading the signals, trading time, preferably trading both, so you understand time more than anything, and really outdo the noise out there. What's out there in CNBC and Bloomberg and these economic reports, especially FOMC meetings, don't trade those. I mean, don't even pay attention. Don't watch that. And just to reiterate one point Mark L made, is that don't look at your screen every day. You might want to know when there's an economic report coming out, but you don't trade based on that. You don't make a decision based on that. And I think there was one comment a couple of weeks ago in one of these webinars where somebody says, I don't trade the FOMC meetings, I'd go flat. Okay, if that's within your risk parameters and your risk tolerance, that's fine. But believe me, what I'm about to show you proves, I think, undeniably, why you should ignore these economic reports. And what I've learned, probably the most valuable thing I could communicate is, other than don't watch your screen every day, because it's going to mess with your mind and it's going to make you kind of overreact and waste a lot of energy because of the swings throughout the day. Do what Mark L says, set up your trades, follow them. Know maybe when there's an economic report, but don't exit a trade if you're already in it because of an economic report. And so let's go to the chart here and look at this. So on, we'll go, the last 3 FOMC meetings are just perfect examples about why you should avoid the noise and not listen to these people like Jim Cramer and all that. That's going to only mess your trading up. So look what happened going back to the first FOMC meeting. It was September 20th, I recall correctly. And there was a We don't have it highlighted here, but there was a time signal that came in about 4 days earlier that would have got you short the market. If you would have got out before the FOMC meeting, you would have made a profit. But if you would have stuck it out just using a 1 bar trailing stop, you would have made 2-3 times the profit. Let's go to the November 1st FOMC meeting. It's not shown here, but if you understand time, or if you've gone through John's tutorial about, tutorial about time, you would have got in before, and you would have been in that trade. What did the FOMC meeting do? Nothing. A little bit of noise, a little bit of jockeying back and forth throughout the day. 1 bar trailing stop would have rode that puppy up. You would have made a nice profit in either the ES or the NQ or any of the equities or indices. There you go. I mean, I've made those trades. I know. And it's tempting to get out because I don't want to get like whipsawed out of a trade. It didn't happen. You were in that trade. Yeah, right there. There was your time signal. Yes, there was your profit. Twice, more than twice. Yeah, there you go. Thank you, John. That's your profit. That's 3x. I think that's 3 times what you would have made if you would have got in that trade and got out the morning of the FOMC meeting because you were afraid that the news, the noise, the language, it's not about the announcement. We kind of know what the Fed's doing now here in this country. It's about the language, right? Afterwards, it didn't do anything. It didn't make a difference. Yeah, and then the last week or a couple of weeks ago, there was a time signal there, got you in, and a little bit of challenge maybe the first day or so, ignoring that inside bar. Remember, John says ignore inside bars. You would have got in on that outside bar, and yeah, that was a time signal, and you would have been in that trade. And you're thinking, Christmas rally, whatever. That's all irrelevant, guys. Remember, it's all irrelevant, guys and gals. Look at that. Look, I mean, you can see right there, 1 bar trailing stop. You would have been knocked out yesterday, but with a really nice profit. If you would have got out the day before, the morning of the FOMC meeting, you would have left a lot on the table, So that's what I've learned is that the most important thing, I think Mark would concur, that's the key, is not to trade the noise, to stick with your trading strategy. So important, so important. You have a strategy, make it as mechanically as possible. This S&P ES chart is just a great example of how if you make it a mechanical, you will do well. And if you don't look at the screen every day, you will do well. If you don't celebrate, and one of the points what I've learned is don't celebrate if you have an open profit. Don't celebrate if you had a weekly profit. Don't celebrate if you had a monthly profit. Now, don't give yourself a pat on the back. Give yourself a pat on the back if you stuck to the strategy. I stuck to the strategy this week. I lost money, but I stuck to my strategy. I know over time, big picture, I will make money with my strategy. And that's so important because if you can do that, you'll be leaps ahead of everybody else out there. Because everybody's looking for a fast dollar, fast money, quick buck. Doesn't exist. If you're a day trader and you can use the Danielcode to day trade, great, go for it. If that's your bandwidth and you can handle that, go for it. I think most people, especially if you have a career, a profession, and you're doing Danielcode for additional stream of income, you should look at really swing trading position, look for those pivots and go with that. It's a better way to go. And like Mark was doing his engineering profession and he would just do trading on the side. It's perfect. Whatever else you got going on in your life, do it on the side. And that's perfect. And just stay away from the screen. It's that dopamine effect. We're all conditioned through tech, with all social media and everything to just click. And that's, the one thing I've caught myself is if I click that mouse or I click that pad, maybe the market's going to change around, go in my direction. No, sorry, doesn't work that way. You got to just kind of break away. and get away from that, and you basically hone your skills to be more of a disciplined trader and more define himself as an anxious trader. We all have a little anxiety, and we all have to deal with that. But you just kind of understand how you operate and kind of work with that, and you can better do that by understanding what motivates you. So and sticking away from looking at the screen so much and worrying about the intraday movements of the market. If you're a swing trader, don't need to look at it. Won't help you. Will hurt you. So just a couple of last things I want to make a few comments on. And I'm glad to come back in a future meeting, webinar, John, and talk a little bit more about trading psychology. Because we don't have time today. I know we're getting on here almost an hour.
Yeah, that would be great. Thank you, Greg. We really look forward to that, my friend. Yeah.
Plus, it's the holidays, and everybody, I'm sure, has a lot on their plate. But take a break away too. Just take a break. Take a break from trading. Maybe next week, abbreviated trading week could get a little bit squirrely. Nothing wrong with taking a break away and enjoying your family and spending time with loved ones. But one thing I want to just throw out there, a couple of insights real quick. So one of the markets that trends beautifully, no matter whether it's winter, summer, spring, summer, fall, heating oil. Trade or follow paper trade heating oil. There's no micro on it yet, so there's a lot of volatility, a lot of tick value involved. So it's a little bit difficult for some traders to tolerate, but at least paper trade it or follow it. It's a great learning experience. It trends, I think, in my opinion, one of the best trending markets out there is heating oil on a daily time frame. The other market, and just look at it here on the algo, and we'll talk. I think John will talk a little bit more about the algo in the future. The other market is NQ, NASDAQ. Again, big volatility, more than the ES, more the S&P, but look at these moves.
Here's the
Yeah, look at these moves. Look at following the trailing stop. Again, I'm excited about the algo. Look how it kept you in that trade. Avoided that really just one to 2 day counter trend move in that $27,000 move. It just ignored it. And with this information, I think we've got the keys to the kingdom here for trading, with time signals especially, which I know, going back to that little move before the elected bar or the setup bar, there was a time signal there. So you would have that validation, and immediately the algo turned the up direction, blue, boom, beautiful. So the NASDAQ, you can trade the micros, and you can trade with one micro, and if you're new and want to go live. I think it's the best way to go. And kind of the point I want to make is that trade a number of different markets, as John says. Don't just trade one market or two markets or three markets. You got to look at 4, 5, 6, 10, and then especially your paper trading, and you can narrow it down to those that you connect with. But if those markets are kind of volatile, like NQ, heating oil, NQ, you can trade the micro and start out with one and get acclimated. And so that's kind of my last point. Get acclimated to the movements in the market and the swings in the market, so you can better adjust and become a disciplined trader and reduce that anxiety that Mark experiences. That's part of the process, is to have that anxiety. It tells you something about you. So understand that when you have that anxiety or you have a losing trade, it's a learning experience. What did I do? Did I do anything wrong? Possibly not. I stuck to the system. It was a losing trade, part of the business of trading. That's okay. But I stuck to the system. So I think I'm coming up on my time. A lot more I could share with you in the future, but just to reiterate, follow heating oil or RBOB. if you choose. They trade pretty similarly. Crude too. Crude's fine, but I think you get more bang from the buck out of heating oil than any other energy market. Oh, and one quick question. Gold and silver, and I know if Harold from Redding's on this, but gold right now, I think the algo turned up, and so I think it's a good time to be looking for an entry if you're not already long gold. I'm long gold, but look at silver. Look at the correlated pairs. Really important, because silver has more bang for the buck too, and actually sometimes trends better than gold, especially on the entry with the time signals. So that's one other thing I want to throw out there. So heating oil, NQ, at least look at it on a correlated basis, and then silver. And honestly, I think silver has more upside potential than gold longer term. So if there's anybody has any questions, you want to throw them in the chat. I know we're at our hour point, so I wanted to stop here, but I got so much more to share, so I'll be glad, John, to be on a future meeting whenever that's appropriate. So if nothing else, then Merry Christmas, and here's to 2024. I think it's going to be a stellar year. So stick to your strategy.
Thank you, Greg. That's absolutely fabulous. And lots of folks here saying thank you so much for your honest and candid comments. So very helpful. A lot of people saying that. They don't hear the right news from all those sources. People don't tell it how it is. They're all selling a product. They're all pushing their trade. But here, you'll get exactly the truth all the time. And the people that are in Danielcode, like Mark L., like Greg Paladini and others, first-class people. Been with us a long time, and wonderful to have their support. Okay, folks, I think that's pretty much getting time running along. If you're interested in taking the Danielcode trading tutorial, where I teach you everything worth knowing, email me, jneedham@thedanielcode.com. We can get you your teaching started between Christmas and the New Year. It will be pretty fantastic. Okay, let's see. Look forward to that. And Nirvana, you've seen this chart several times. This is what your trading should look like. Suck it in, internalize it. That is trading Danielcode time cycles. And here is the gold chart that Greg talked about. I show this often. This is gold for the last 2 years and 8 months. And it has just got a 29-day time cycle run through it. All of those turns that you can see came at the end of relative time cycles. Every important high, every important low. This is a difficult market. It's a complex market, gold, so I picked a hard one. Every turn comes at the expiry of a Danielcode time cycle. Not anyone else's time cycle, just the Danielcode time cycles. So that's it. If you haven't already, folks, please help yourself to a free trial. If you have any problems getting access, contact Terry at support@thedanielcode.com. And second item to finally is our disclaimer, which I do ask you to take seriously. It's very easy to lose money if you don't know what you're doing. In the same way, it's very easy to make a lot of money once you do know what you're doing. So get trained, get to understand markets. They are your friend. They exist to give you wealth, health, and happiness. And that's us for the time being. Merry Christmas to everybody from me, from Akshay, from Chip, from Mark. Oh, my Lord, look at this. Everyone's happy Christmas. Merry Christmas to everyone, folks. Wonderful stuff. Let me see if I missed those. Here we are. Thank you, Mark. It was great. Happy holidays, Chip. Yeah, wonderful. Terrific. Chip really enjoyed it. He's a very long-term Danielcode member. He's done a tutorial as well. Wonderful. Thank you, Chip. Happy Christmas to you, my friend, to all of you. Akshay, to you too. Mark, of course. Bart, new guy, all the best to you. Nice to have you with us. And Rob, wonderful to have you with us. And Ray, Merry Christmas to you, my friend, indeed. And everyone, be safe. Have a wonderful time, and we'll hope to see you all at the next webinar, which will be in 2 weeks' time. All the best for now. Merry Christmas and bye-bye for now.